Financial institutions across the United States are witnessing unprecedented levels of concern among depositors following widespread misinformation about federal banking regulations in 2026. Viral claims circulating on social media platforms suggest that ordinary Americans face automatic $10,000 penalties from the Internal Revenue Service for routine bank deposits. Investigative analysis reveals these assertions misrepresent long-standing federal requirements while obscuring genuine compliance considerations that warrant public attention. The fundamental premise driving current anxiety proves demonstrably false upon examination of existing statutes and regulatory frameworks. No legislative action in 2026 established novel restrictions on Americans depositing currency into personal banking accounts. Citizens maintain full legal authority to deposit $12,000 from automobile sales, accept $15,000 from family members assisting with healthcare expenses, or transfer $20,000 between personal accounts for home improvement projects without violating federal law. However, financial experts emphasize that dismissing all concerns would constitute equally irresponsible guidance. Significant developments in enforcement methodology and technological capability have fundamentally altered how federal agencies monitor financial activity. Understanding these changes proves essential for retirement-age Americans managing accumulated savings and fixed income streams. Currency transaction reports represent the regulatory mechanism generating current confusion. Financial institutions operating under United States jurisdiction have maintained mandatory reporting obligations since the 1970s when Congress enacted the Bank Secrecy Act. This landmark legislation requires banks to submit standardized documentation to federal authorities whenever customers conduct cash transactions exceeding $10,000 within single business days. The operative term demanding clarification involves the definition of cash. Federal reporting requirements specifically address physical currency transactions involving paper bills and coins. Electronic transfers, personal checks, direct deposits from employers or government agencies, and wire transfers operate under entirely separate regulatory frameworks. Americans receiving Social Security benefits through direct deposit or pension distributions via electronic transfer encounter no currency transaction report, regardless of amount. Banking industry representatives confirm that financial institutions file thousands of these reports during ordinary business operations. The overwhelming majority generate no subsequent investigation or correspondence. Reports enter federal databases where they remain available should future circumstances warrant examination. Routine compliance represents standard banking practice rather than indication of suspected wrongdoing. Contemporary concern stems from dramatic advancement in governmental data processing capability. Federal agencies, including the Internal Revenue Service and Financial Crimes Enforcement Network, now deploy sophisticated algorithmic systems capable of cross-referencing multiple information streams simultaneously. Bank reports, tax returns, Social Security Administration records, pension distribution documentation, and property transaction filings undergo automated comparison through artificial intelligence platforms operating at speeds impossible for human analysts. This technological evolution produces consequential implications for American depositors. Discrepancies between reported income and banking activity surface with unprecedented efficiency. Whereas previous decades allowed inconsistencies to remain undetected indefinitely, modern systems identify potential anomalies within months of their occurrence. Consider circumstances facing hypothetical retired individuals selling recreational vehicles for $18,000 in cash. Proper procedure involves depositing full amounts in single transactions, allowing banks to fulfill reporting obligations. When subsequent tax returns fail to acknowledge sales or associated capital gains, automated systems register apparent inconsistencies. Such flags do not automatically generate penalties. They initiate verification processes requiring taxpayer response. Financial professionals distinguish clearly between inquiry and enforcement. Receiving correspondence requesting clarification differs fundamentally from receiving penalty assessments. Documentation resolves most inquiries without financial consequence. Problems escalate primarily when recipients ignore official communications or provide inaccurate responses. Misleading online content, conflating routine reporting with automatic punishment, creates unnecessary anxiety among vulnerable populations. No credible evidence supports claims that thousands of retirees face surprise $10,000 penalties for innocent deposits. Federal enforcement data reveals agency focus remains concentrated on detecting intentional evasion rather than penalizing inadvertent reporting variations. Genuine legal jeopardy exists within one specific behavioral category that federal authorities actively prosecute. Structuring constitutes deliberate fragmentation of large cash amounts into multiple smaller transactions specifically intended to circumvent reporting thresholds. This practice has remained explicitly illegal throughout decades of the Bank Secrecy Act framework. Illustrative scenarios demonstrate prohibited conduct. Individuals possessing $15,000 in cash who deliberately deposit $9,000 on Monday and $6,000 on Wednesday specifically to avoid triggering reports engage in structuring. Intent to evade reporting requirements transforms otherwise legal deposits into federal violations carrying substantial consequences. Civil penalties for structuring violations begin at $10,000 per incident. Egregious cases involving clear criminal intent may result in prosecution carrying potential imprisonment. Federal courts have consistently upheld structuring convictions even when underlying funds derived from entirely legitimate sources. The violation involves concealment methodology rather than fund origin. Critical distinction separates intentional structuring from coincidental deposit patterns. Americans receiving multiple payments through ordinary financial circumstances encounter no legal exposure. Depositing $9,000 from insurance reimbursement during 1 week and $11,000 from pension distribution during subsequent weeks presents no structuring concern absent deliberate evasion intent. Federal prosecutors must establish knowing circumvention of reporting requirements to pursue structuring charges. Problematic scenarios emerge when automated systems identify patterns suggesting potential structuring without access to contextual information. Repeated deposits consistently falling just below $10,000 thresholds across compressed timeframes attract algorithmic attention. Systems detecting such patterns may generate enhanced scrutiny, even when depositors harbored no evasive intent. Practical guidance for retirement-age Americans involves straightforward behavioral modifications, eliminating inadvertent risk. Cash amounts exceeding $10,000 should be deposited through single transactions. Attempting to divide large cash sums across multiple deposits creates appearance of potential structuring regardless of actual motivation. Allowing banks to file routine currency transaction reports represents safest practice. Americans uncomfortable with large cash transactions may request alternative payment methods when selling valuable property. Accepting checks or arranging electronic transfers for vehicle sales, estate sales, or similar high-value transactions eliminates cash reporting considerations entirely while establishing clear documentation trails. Gift transactions frequently generate confusion among retirees receiving substantial financial assistance from adult children or other family members. Deposits of checks or electronic transfers from family members trigger no currency transaction report regardless of amount. The $10,000 reporting threshold applies exclusively to physical currency. Recipients of monetary gifts generally incur no income tax obligation regardless of amount. Gift tax responsibility falls upon donors rather than recipients. Gifts exceeding annual exclusion amounts require donors to file informational returns with federal authorities, but do not create taxable events for receiving parties. Separate regulatory frameworks govern gift taxation and banking transaction reporting. Transfers between accounts held by identical individuals similarly avoid currency transaction report requirements. Moving $20,000 from savings accounts into checking accounts, even across different banking institutions, involves electronic record transfers rather than cash transactions. Americans may manage personal funds across multiple accounts without triggering $10,000 reporting thresholds. Foreign account reporting requirements represent genuinely elevated enforcement priority, demanding attention from affected Americans. Citizens maintaining signature authority over foreign financial accounts must file foreign bank account reports when aggregate balances exceed $10,000 at any point during calendar years. This requirement exists independently from domestic banking transaction reports. Civil penalties for non-willful foreign bank account report violations begin at $10,000 per unreported account. Willful violations carry substantially higher penalties, potentially reaching 50% of account balances or criminal prosecution. Electronic filing through financial crimes enforcement network systems must occur by designated annual deadlines separate from income tax return submission. Retirement account distribution requirements constitute additional compliance consideration for Americans reaching mandatory withdrawal ages. Required minimum distributions from traditional individual retirement accounts and employer-sponsored retirement plans must commence by specified ages. Failure to withdraw required amounts triggers penalty taxes potentially reaching 25% of undistributed sums under current law. Recent legislative modifications reduced certain required minimum distribution penalties from previous levels. However, substantial consequences remain for Americans failing to calculate and withdraw mandatory amounts. Financial advisors recommend annual review of distribution obligations as retirement accounts grow in complexity. Documentation practices provide strongest protection against compliance complications regardless of specific regulatory concern. Americans should maintain records of property sales, including bills of sale, specifying transaction terms, and buyer information. Gift transactions benefit from written letters acknowledging transfer circumstances and amounts. Property settlements, pension distributions, and Social Security benefit statements require organized retention accessible for potential verification needs. Tax return preparation demands careful attention to consistency between reported income and banking activity. Capital gains from asset sales must appear on appropriate schedules. Pension distributions require corresponding documentation. Automated comparison systems flag discrepancies between institution-reported payments and taxpayer-acknowledged receipts. Alignment between data sources minimizes inquiry probability. Americans receiving Internal Revenue Service correspondence should respond promptly within specified deadlines. Official notices specify requested information with clarity. Submitting photocopies rather than original documents protects irreplaceable records. Complex matters involving substantial sums or disputed interpretations warrant consultation with certified public accountants or licensed tax attorneys. Financial industry observers confirm continued evolution of digital oversight capabilities throughout 2026 and beyond. Banking institutions increasingly deploy artificial intelligence systems identifying unusual patterns beyond simple threshold monitoring. Algorithmic analysis considers transaction timing, frequency, amount variation, and relationship to historical account behavior. These sophisticated systems target indicators consistent with money laundering, fraud, or deliberate evasion rather than ordinary financial management. Nevertheless, retirees unfamiliar with algorithmic pattern recognition may inadvertently create appearances inviting enhanced examination. Understanding how systems interpret behavior enables Americans to conduct routine transactions without generating unwarranted attention. Regulatory frameworks governing financial reporting reflect genuine law enforcement priorities addressing serious criminal activity. Money laundering supporting drug trafficking, Terrorism financing, tax evasion schemes, and organized crime operations depend upon concealing illicit funds within legitimate banking systems. Currency transaction reports and related monitoring mechanisms provide investigative tools for detecting such activity. Ordinary Americans conducting lawful financial transactions occupy entirely different categories than targeted criminal enterprises. Compliance obligations exist for all depositors, but enforcement consequences concentrate on intentional violators. Maintaining transparent practices while understanding reporting requirements allows retirees to manage personal finances without anxiety. Emotional responses to financial uncertainty prove counterproductive when driving decision-making. Withdrawing savings from banking institutions based on misunderstood regulations creates genuine risks, including theft, loss, and foregone interest. Attempting to circumvent perceived restrictions may constitute actual violations of laws that straightforward compliance would never trigger. Informed engagement with financial systems represents more effective protection than fearful avoidance. Americans benefit from understanding currency transaction report requirements, structuring prohibitions, foreign account reporting obligations, and documentation best practices. Knowledge enables confident participation in banking relationships, essential for modern financial management. Professional consultation remains available for Americans facing specific compliance questions. Bank managers can explain institutional reporting procedures. Tax professionals provide guidance on return preparation and correspondence response. Financial advisors assess overall retirement planning, including distribution requirements and account structure. Proactive guidance costs substantially less than reactive defense against enforcement actions. Investing modest sums in professional consultation before executing complex transactions prevents potentially significant complications emerging months or years later. Americans uncertain about specific circumstances should seek clarification before proceeding. Statutory penalty amounts cited in alarming online content typically represent maximum potential assessments rather than routine impositions. $10,000 penalties constitute ceiling figures for specific violation categories. Actual assessed penalties depend upon individual circumstances, including violation severity, intent evidence, cooperation level, and compliance history. Context determines outcomes. Federal enforcement agencies maintain discretion in pursuing cases and calculating penalties. First-time technical violations by cooperative taxpayers rarely result in maximum penalty assessments. Willful, repeated violations by uncooperative subjects face dramatically different treatment. Categorical claims about automatic penalties misrepresent nuanced enforcement reality. Retirement savings represent decades of labor, sacrifice, and disciplined financial management. Protecting accumulated assets requires neither withdrawal from banking systems nor fearful avoidance of routine transactions. Understanding regulatory frameworks while maintaining organized documentation allows Americans to manage wealth confidently throughout retirement years. Transparency consistently outperforms concealment as protective strategy. Proper reporting eliminates structuring concerns. Organized records enable rapid inquiry resolution. Responsive communication with regulatory agencies demonstrates good faith. Americans embracing these principles navigate financial compliance requirements without significant difficulty. The current information environment rewards sensationalism over accuracy. Claims generating fear attract attention regardless of factual foundation. Responsible financial management requires filtering alarming assertions through critical analysis. Verified information from authoritative sources provides reliable guidance that viral social media content cannot match. Americans entering 2026 should approach banking relationships with informed confidence rather than unfounded anxiety. Long-standing reporting requirements continue unchanged. Technological advancement increases pattern detection capability without altering fundamental legal obligations. Documentation and transparency remain paramount protective practices. Knowledge proves more powerful than panic. Preparation supersedes surprise. Understanding defeats uncertainty. Retirement age Americans possessing accurate information about federal banking regulations can manage accumulated savings effectively while maintaining full compliance with applicable requirements.